Thank you. I guess I'm starting at the end, but at the same time, I'm going to go from everything that you've heard, which has been very much a detailed view to a 20,000-foot view again. And we'll start that by, let's see, there we go. We'll start that by, going back to the question of what is energy transition. And this is all data that we work internally. These are outlooks that we work internally. This basically looks at, what are we starting out in terms of the tons of oil equivalent, in terms of the different fuels, what sectors does it go to, what transformations does it go through, and how does that change over time? Critically here, we look at the intersection of policy, of technology, and of markets. And when we think about what's driving the energy transition, we've got the policy side. Everyone talks about carbon. We spend a lot of time understanding the carbon markets. We understanding the carbon intensities, the alternatives to carbon, and that's where a lot of the metal, the drilling for metal and minerals rather than drilling for oil comes in. But it also comes down to biodiversity. This has been a key year in terms of biodiversity. We spent a lot of time looking at key biodiversity areas, overlaying those with key mining areas, and understanding where some of those risks lie. There's also the pressures on policy around circularity. And this is where some of our price assessments, and we launched a very new price assessment around black mass, which tries to provide some transparency into that process, into the process of understanding how you can actually meet the needs of the energy transition without actually mining as much and doing more of the recycling. I think that's one of the key things that when we look at, it's about how do you move away from the virgin usage of these materials to some of the recycling, and we're hoping that the black mass price assessments that we have are among the price points and transparencies that can inform this. So moving on to kind of what are we seeing, and what makes this a fascinating space is how big a diversity there is in terms of what the scenarios are. And this is basically a scenario, this shows our scenarios. We titled them as inflections, which is sort of our reference. Green rules, which is a very aggressive green scenario. We have a discord scenario, which assumes that not too much cooperation, not too much trade, a lot of individual efforts, lack of cooperation on technology, and then two key cases that try to get us to net zero. One of them is a CCS-focused case. One of them is more of an all of the above case. And you can see just here in terms of, yes, the next 5 years, we are in a very unique period where we actually see emissions going up. We see a lot of usage of fossil fuels going higher. I'll kind of touch upon this. But then after that, we do see a period where we start shifting over and where the transition starts changing. And that's where you start seeing the big diversity, the percentage of fossil fuels as share of total energy demand. This is a big difference. These are the risks that as you look further out, you want to take a look at. And what does this mean in terms of the policy drivers? You look at the climate challenge. Well, the difference between our discord scenario and our net zero scenarios is a pretty major difference in terms of temperatures. Those temperatures have implications for our GDP. They have implications for operations. They have implications for a lot of physical risk. It's another set of tools that we also provide is information on any particular asset, the potential for physical risk around temperatures, around flooding, around heat waves, et cetera. So these are all pieces that we figure in when we develop these scenarios. And then we take a look at at the global level, what are we seeing in terms of the drivers? Well, we've seen a lot of talk about the Inflation Reduction Act. This is essentially a carrot national domestic. This is the difference between our sort of green rules and our discord scenarios. Or do we have unilateral approaches? Do we have multilateral approaches? Do we have sticks in the form of taxes, in the form of bans on certain types of technologies, in the form of bans on development? And this is the paradigm through which we start looking at the world that we're in. We asked our clients, what are the most important drivers today in the energy market? And the energy market is the flip side of the metals market in terms of storage, particularly. The key issues that people are finding are actually, it's the geopolitical turmoil and the uncertainty is number one. The other key driver is country-focused climate and clean tech policy. So once again, this is nothing that I'm sure you've heard for the rest of today about the importance of the IRA as a driver, and as a driver particularly of some of the energy transition minerals. Rising cost of capital. This is impacting everybody. This is the weaponization of energy. I'm not going to go down the entire list. Cost of carbon is in there. China's growth trend. These are who our clients identified, what our clients identified. And then the key question is if you take your geopolitical turmoil, if you take your concerns about energy security, what does that mean for the energy transition? Does this mean we're going to move more quickly? Does this mean there's going to be more of a push towards alternatives to fossil fuels? Or does it mean more of a retrenchment and a usage of what you have? It wasn't a clear answer, but most of the assumptions are that security concerns will actually intensify decarbonization and climate action, and that's something that we share in our inflection scenario. And so, a quick summary of what we're seeing, and in terms of the fundamental elements to all of our climate scenarios. We have crises. We have Ukraine. We have a fragmented world order. We have governments' responses. We have energy security, record level of public and private money. I think this is one of the things that we are also tracking, particularly from the private equity side. We're not seeing as much in terms of traditional debt finance, but we are seeing, particularly leveraging a lot of what's going on with the IRA, we're seeing a wall of capital that's deploying. And the question is, where is it deploying? Some of those deployments are more traditional, sort of wind and solar. Some of these deployments are waiting for more guidance on carbon capture and hydrogen, and all of those have different implications for the mineral and metal sectors. Going to our sort of inflections case. Well, what are we seeing? We're seeing some fundamental points, turning points in international relations. We see the greater instability. We see national security interests, key countries pursuing industrial policies, successful implementation. So what does all this mean in terms of our outcomes? And this is really highlights the changes. And you can see in terms of global primary energy demand, well, from a year-on-year basis, 2022 doesn't look that much different from 2023, but our inflection scenario, what does it tell us? That we still have oil as a key contributor to total primary energy demand, even in our 2050 outlook. Now, energy demand, that is not this is not all energy use for energy use. Some of this is feedstock for petrochemicals. That's a big part of oil use. So take that in mind, that we actually, and I'll show you some features as to how much we're expecting that oil use to be substituted by electrification. You can see also the importance of renewables, how much, we're talking scaling, we're talking levels of magnitude of greater renewables than we've ever seen before. This is a energy transformation. We've gone from wood, we've gone from to oil, to gas, to coal, to nuclear. What we're expecting in our reference case on renewables is unlike any speed of transformation we've ever seen before. So now, and if you go to any of the other cases, we have a green rules case, we have a net zero case, that will be even more pressured and will have even more pressures in terms of all the supply chains. Now, I'm saying this even as in our short-term estimates, we're actually expecting more coal burn and more oil burn than we did last year. And this is because this dichotomy. In the short run, the responses are to use what you have. You have to keep the lights on. You have to keep the capacity margins in place. And this is still somewhat of a COVID rebound, where we're seeing coal jumping back like we haven't seen before. We're going to hit new peaks. We're going to hit new peaks for oil, and that's going to happen for the next 5 or 6 or 7 years. But then the response, and this is what our clients have told us that we've been echoing as well, the response on energy transition is going to be even stronger in terms of the subsequent movement. So everyone's question is, when do we see peak oil? When do we see peak gas? When do we see peak coal? Well, we're at this phase right now. You can see the 2020 to 2025 where we're really upswinging, but we are hitting that peak. And you can also see the wide range, and particularly when you're talking about oil, this is where the uncertainty about availability of alternatives is. You can see this massive gap in oil demand. These are two credible scenarios. It's not as if this is one is our clear reference case and the other one is some made up policymakers case. These are two credible scenarios with a massive range in differences in terms of primary oil demand, and that implies a massive range of differences in alternatives to that oil demand. You can see the same difference in terms of gas demand. You can see the changes in coal. Actually, with coal, you don't see as much of a difference because we see coal essentially fading after this near-term shift in any of our scenarios. That's something that there's just too much momentum that's been put in place. And so I want to shift over to the transportation sector and really focus on what we see some of the risks. I showed oil in our reference case. I showed oil in our green rules case. Huge difference. Well, where does that difference lie? Part of that difference will be outside the energy sector. Part of that will be petchem. And if there is a magical world of petchem recycling where you can recycle all your plastics, not have to have as much virgin feedstock, that will drive down oil demand. But let's talk in the transportation sector. Let's talk about energy use to fuel our cars, our trucks, our planes, and our ships. And this is with the most direct implications for what we know about battery metals and all of the implied metals associated with electric vehicles and electrified transport. Well, I think it's been accepted, and we agree that essentially battery electric is essentially the dominant pathway. I think we called it. There are still hydrogen fuel cell cars being sold. There still is ethanol and going into gasoline. E-fuels, well, e-fuels involves capturing carbon and recreating fuels. That's not going to make sense for vehicles. Other low carbon intensity fuels also not making sense. So that is our reference case, is assuming that that's going to happen, and essentially that's going to be that electricity is going to be fueled by increasingly low carbon. Those cars are going to be fueled by increasingly low carbon electricity. Big question. And this comes down to, anytime you look beyond 2030, whether in terms of forecasts around what batteries are going to look like, what metals you're going to need, is that trucking question. And what you can see is we haven't picked a green check mark here. We haven't picked a dominant pathway because it's still to be determined. Certainly we see technologies being announced. We see Tesla and others announcing electric trucks, but there's still that issue of density. And the density is a function of your battery chemistry, as you know. So remain to be seen what happens there. Hydrogen fuel cells, there's an argument to be made that is a real contender. There are hydrogen fuel cell trucks. There's arguments in terms of range, in terms of refueling, that is going to be a solution. Biofuels. Well, if you look at the California low carbon fuel standard, if you look at what California is doing to replace all their diesel, hasn't been electricity, hasn't been hydrogen, it's been renewable diesel. So biofuels are still very much in play, and that's going to be competing with hydrogen fuel cells. That's going to be competing with battery electric. But then the question, like everything else, you have to go back up the supply chain. So if you're talking about biofuels, what's the risk there? It's feedstocks. Do you have enough cooking oil? Do you have enough soybean oil? Do you have enough, let's say, ethanol to SAF, to sustainable aviation fuel, to actually fuel this transformation? That's something that, again, remains to be seen. This is why, if I had to pick what we wanted to look at in terms of potential upside or potential flatlining of metals demand or battery demand in the transportation sector, trucking would very much be in play. Likewise, the others are also simpler. With planes, we have seen some demonstration planes with flying on batteries. That's not an expectation that's what's going to happen in the long term. That's not what's going to happen for long flights. And the reality is that short flights are actually being banned in a number of countries already because of their carbon footprint. So for planes, we are really seeing biofuels as a solution. This is sustainable aviation fuels. You've seen the announcements. If you fly, you see airlines claiming carbon neutrality. Some of that's in the form of offsets. A lot of that's in the form of sustainable aviation fuels. And that's where also e-fuels and other low carbon intensity fuels come in. And then shipping, yes, there's an argument particularly for short-haul flights, for short-haul shipping, for ferries that battery can serve. But once again, there are other alternatives. Hydrogen fuel cells, we don't really see. Biofuels, it could work, but it is, like we said, limited feedstocks. Where the biofuel is going to go, they're probably going to go into the planes because there are not as many alternatives for planes. For ships, the alternatives really are hydrogen-based fuels. We do see fuels like methanol. We do see fuels like ammonia basically playing in that space. So if you split out the sort of the potential oil demand, the liquids demand that could be replaced by electrification and therefore by batteries, cars, yeah, it's there. It's, you know, that's going to happen. Trucks, that's a big, huge question mark. What's going to replace all that diesel? Short run, it's biofuels. Long run, could very well be batteries. We're talking a lot of potential underlying metals demand, but by that time, particularly for trucks, the weight is going to be critical. The battery chemistries are going to be critical as well. And then for planes and ships, we actually don't expect much in the way of electrification, but you know, never say never. I think it's something we're tracking. And to kind of go back and, you know, show past as and highlight the fact that yes, electric vehicles is where it's happening, is that we just went through COVID. We went through the auto sector facing lots of challenges, including a chip shortage, where overall auto sales were rather weak, and we still had this record uptick in terms of plug-in light-duty electric vehicle sales. Now, the U.S. is at the bottom of that. It's in red. If you look where that is happening, a lot of that's happening in Europe, where you actually have diesel being displaced, because a lot of the European cars are diesel. And you have China, where you have a lot of first-time buyers. So it's not even, you're not even displacing fuels, you're avoiding fuels by avoiding liquid fuels. What you're burning is actually the coal-fired electricity, but that's also seeing a transformation in China. So that's, what are we seeing in the US? Well, we're also seeing records. You can see the first 3 months of this year higher than any year so far. 2022 was higher than any year so far. So on an absolute level, we're seeing light-duty electric vehicle sales going up, and the additional incentives provided by the IRA on top of all of the other incentives that are in place regionally, driven by California, driven by New York State, driven by Oregon. This is what's continuing to drive this. The key issue for the US was the availability of models, and we're seeing that finally turn the corner as well. And so what are we seeing in the US? Well, it's, like I said, it's been the laggard in terms of vehicle share. We've seen Norway hit 90% of new vehicle sales being electric. U.S. is kind of in you know, 7% is a big deal for the U.S., but this is something that's been increasing. The total numbers are increasing, and this is just a short run. I'm just showing history here. This is not going forward. What we see going forward, more electrification. This is absolutely clear in the light-duty vehicle side. The electric, we do see those really dominating. You know, hybrids play a role, plug-in hybrids play a role, but the internal combustion engine increasingly less and less of the new sales. The number of cars, the number of batteries, the average battery size. This is also things that we're looking at. And this also gets to the point of sustainability and policy that I mentioned earlier, because last week EPA, you know, in terms of RCRA, noted that batteries are actually, you know, cannot be disposed. That's a hazardous disposal. So there's a memo out. So, you know, if you believe that this is the trajectory of electric vehicles, that's a heck of a lot of batteries that are not going to be able to be disposed of in a regular, cheap manner. So then the question is, what are the incremental costs? And this is kind of where the feedback loop comes in. You have those incremental costs. Are you going to be driving more recycling? If you're driving more recycling, what will that look like? This is where, you know, some of our black mass price assessments, you know, we see right now we have, you know, two different chemistries for the black mass price assessments. That's something that we see as getting legs, particularly with guidance like the EPA issued last week. So these are additional things to think about. And then, you know, you can talk about the economics driving things. We can talk about battery, you know, the recycling making batteries more expensive. But there are absolute bans and absolute targets being put forth by governments that are going to drive this one way or the other. And then the question is always, who ends up paying? Who bears the cost of this? How high up does it go? Is it the OEM? Is it the final consumer? Where does that actually get passed on? Because we've seen cities ban internal combustion engines. We've seen states go ahead and put deadlines in terms of sales on internal combustion engines. we've seen, and this is just a range of a lot of different jurisdictions. And then the question then also becomes, it's not just do you just get a battery electric vehicle? Does that actually get you scot-free? Well, we know it doesn't, because then it's a question of decarbonizing the automotive industry, and this is where life cycle assessments become critical. And this is our version of what you've seen life cycle assessments on in that bar chart on the right. You can see the raw materials when you're buying an internal combustion engine. There are the raw materials involved. There's also the emissions associated with the product usage. That's really where you're using liquids, and you're basically getting emissions from the gasoline or diesel. And then you can see the difference on all the way on the right-hand side on the battery electric vehicle. You can see the difference between a BEV in a conventional power system, and on the right-hand side you can see the difference between that and a power system that's 100% renewables, or where the buyer is contracted to going with 100% renewables. So all in, we're looking at about a 61% reduction if we go from a conventional internal combustion engine to a clean power battery electric vehicle. There is still that carbon debt that comes from manufacturing the battery, from processing the materials. That is the carbon debt, and honestly, to get that back, you need to drive the car. So as both cars leave the OEM plant, it's the electric vehicle that is much more carbon intensive. It has to be driven. It has to make up that difference by actually being used, and that's kind of where the utilization comes in as well. So just wanted to and these are kind of just want to highlight some of the analyses that we do. It's S&P Global. If you are not familiar, we've recently gone through a major merger with IHS Markit, which means we've also merged with the IHS Mobility team. We have a massive team looking at all of the different both battery and mobility alternatives, the drivetrain alternatives, looking at it from a perspective of OEMs, of materials, of carbon intensity, et cetera. And it's these types of efforts that we are putting together on the transportation side. With a little bit more time, I just wanted to touch upon the other piece. People don't really talk about it as much, but there's also the stationary storage piece. All those renewables that are needed to decarbonize the power sector, they are intermittent. We all know this is, we have wind and solar that need to be shaped, and that power needs to be shaped, that needs to be formed, and that's done through either demand side or through supply side changes. And I mentioned this, we're seeing an increase in solar PV and wind like we've never seen before, a 10 times greater installed capacity by 2030 than we saw in 2015. Well, that's what we're seeing in terms of the low carbon power generation. In terms of global grid connected electricity storage, it's gone 300 times up. So we're talking about, this is grid connected storage 300 times. This is a scaling that we haven't seen. This is on top of all of the transportation related batteries. And where's that coming in? That's coming in the US and China right now. They account for nearly, essentially 60% of the energy storage installations that we expect through 2030. The rest of the market is fragmented, but US and China, they're really driving this. And in terms of where this is coming in, most of this is coming in front of the meter, which means that this is basically supporting the grid. Some of it is behind the meter. So if you have a solar panel on your roof and you have the additional certainty for reliability by having a battery behind the meter, then that's the residential part. And then there's commercial and industrial sources. I mean, if you're anybody who has large scale electricity demand, you've got a demand charge and you have the power that you actually pay for. Well, if you can knock off your demand charge by having a battery kick in during peak times, that you can really knock down your power prices. And that relates to any sort of industrial or mining operation. If you're in a market that works that way, then storage is a solution as much as it is a final end product for the materials. And these are the types of end uses that for battery storage, stationary storage. It's first of all supporting the grid. providing backup. We've heard about jurisdictions where you just heard about jurisdictions where you didn't have the certainty of supply. Well, this is how you get some certainty of supply. You don't want to build that transmission line to get that supply. You can build in a battery. You want to optimize your portfolio. You want to arbitrage cheap prices, expensive prices, cheap prices, bring nighttime prices to daytime prices. So these are all the factors. And if you look at what we're expecting in the US, well, we absolutely are expecting increases in terms of solar capacity. This is in terms of our growth. Where are we seeing the storage in the US? That these are all the sinks for the batteries and for the materials. We see particularly strong the Inflation Reduction Act in terms of what it's doing for battery storage. It's being explicitly supported. It's being supported by very strong tax credits, and this is going to drive major capacity additions. You can see history there, but I think if we talk about drivers, you can see where we see this is going. And once again, where we see it going in places like actually, let me go to here. In places like Texas, in places like California, in places like Nevada, these are huge solar and wind generators, and these will be huge sinks of storage, which will be essentially mostly batteries. There are other technologies in place, but the fact that lithium-ion batteries have been so supported by the transportation sector means it's very easy for them to scale and move to the stationary sector. So this is another big sink and potential sink for metals and products. Now, we also, as through our Platts division, we do price assessments. So we price a lot of these battery metals. The volatility, as we know, has been dramatic over the last few years. And what this means is this also means a pretty great volatility in terms of costs. And this is just comparing 3 days for 3 days for 3 different battery chemistries, and how much those costs have changed. You can scale them in terms of the 3 metals that we're focusing on: the lithium, the nickel, and the cobalt. Big differences, and this is part of the problem. If you're buying on a spot basis, well, people don't buy on a spot basis. But if you think about the end users and the OEMs, this is why they want to move back and make sure that they get some ways to hedge these potential price changes. Just another, I'm sure you've seen many other charts around supply, demand, et cetera, and we continue to forecast those in terms of both how much the EVs and how much the batteries make up of the total share, as well as where it's coming from. And this is once again another part. We have a metals group that actually goes and looks at the upstream mines and looks at their marginal costs in terms of developing these our forecasts. And another, once again, we develop balances. This is from our metals group. I'm kind of borrowing from them here. We all expect deficits by 2027 in each one of these key metals. The struggle is, if you look at the average lead time of mines, we've done a recent study on this to understand all the different segments, starting with the discovery, and then the construction decision, and then the actual construction to start up. It's going to be a challenge, and it's a question of, will prices be able to respond to the challenge? And in the limited time, just want to also throw up, I think this is a really nice colorful chart, so a nice little splash of Skittles at the end. But this is actually a very serious topic. It's the whole geopolitical side of things. And it shows where we expect the various sourcing for some of the key raw materials, refined materials, and manufacturing to take place by country. And this is partially driven by what we are seeing as the industrial policy that I started this presentation with. I guess I just added this at the end. There was another big IRA push is hydrogen. And so not to just focus on battery metals, wanted to throw this in because iridium and scandium are pretty important when you're building electrolyzers, and there's going to be a heck of a lot of electrolyzers built if you follow the forecasts of the IRA. So I think I did a whirlwind tour in half an hour, so I'll let you take a breath, catch a breath. I'll catch a breath, and if you have any questions, please reach out. And we have research data background for high level, detailed, etc. So any interest, do follow up. So thank you.